Okay, Alec, all good to go?
There we go. I just wanted to get my webcam on to show you that I am alive and well and talking to you from London today, where things have been, the weather's been pretty good. We've got an interesting month behind us in the portfolio. I'll take you through all of that in just a moment. But of course, in Johannesburg, as always, I'm managing editor Stuart Lohman.
Thanks, Alec. Good to be here for another month on the SA portfolio. Just a quick one. Can people please raise their hands to make sure that the sound is coming through okay on your side? Those listening?
There we go.
There we go. Got some hands, Alec. That's great. Thank you very much. And then just on the questions, we like to keep it very sort of conversational. So if you please just jot your questions down in the questions sort of bar on the right-hand tool control panel. I'll pass them to Alec and we can sort of break into conversation and get some answers back. So, yeah.
Fabulous. And I see there are a few questions there already. I guess today what we should try and do, last month we got bogged down, not bogged down, but we got taken away with all the questions. So if you do have questions, please try and put them through so that we can get around to them. But this time, perhaps we should go through the whole presentation, and then as you see ideas or as questions come through during the presentation, just make a note of them, and Stuart will stop me if it's something particularly important at that point. Otherwise, we'll go. We can carry on from there. It's really a pleasure and a privilege to be with you again this month. It has been an interesting time for the portfolio, and as you'll see in a while, the performance is now starting to improve quite nicely. But getting back to the overall picture there. Oh, by the way, you did see in the picture that I have the microphone on. That's after a request that the audio was not quite as good as it should have been last time around. So we've made a few little technical changes, and now we have the mic ready for you. Okay, into the portfolio itself, and let's have a look at how things are going. Before we start, just to remind you that it is a hedge against the rand decline, and that is the way we do this is we have a look at South African companies, in other words, companies that are listed on the Johannesburg Stock Exchange. That's the first priority. So you can invest in these companies in rands, and then we take a rule through them, try and find the companies that we believe offer the very best value, and they have to be companies that are primarily operating in the global environment. That is what gives them their range head element. There are a number of companies that we look at from time to time. For instance, Famous Brands is an example of a company that we did do quite a lot of work on and don't like because of the investment that they've made in the UK, a 2 billion rand investment that, well, has gone pretty sour. There was lots of talk on the ground here that Famous Brands had bought in at the wrong time. And the share price, although it's down significantly, doesn't fully reflect the problems that Famous Brands is picking up. What it did was just over a year ago, it acquired Gourmet Burger for just over 2 billion rand by borrowing a lot of money to make the investment. At that time, Gourmet Burger was generating, but 70-store chain, was generating about 170 million rand in profit. It's now going to make a loss. So there's been a huge decline, and on top of that, the borrowings have skyrocketed for Famous Brands. So one bad deal can derail you if you're making a deal in an offshore location, and that's an example of that side. We have, of course, got that experience in our own portfolio as well with Brait, and I can take you through a little bit more of that in time. But Brait had, well, they made 4 big deals in various parts of the world, 3 of them in the UK, and one of them was a real shocker, and it's a company called New Look, a fashion retailer. Word on the street here still is that New Look is teetering and is not going to be making any rebound anytime soon. I've got a lot more faith in the entrepreneurial prowess of Christo Wiese, and I'm hoping that that is justified into the future. Wiese, in fact, has quite a significant we have a significant exposure to him in this portfolio, both through Steinhoff and, of course, through Brait as well. But that's the idea. The idea is to invest in South African companies that are listed offshore, or rather listed on the Johannesburg Stock Exchange, but that operate offshore. One that's come onto my radar, and I've looked at and thought very deeply about it, but haven't quite built up the courage to make the investment yet, is Sibanye Stillwater. When Sibanye announced the transaction for Stillwater, I was very negative on it, and that is probably justified. Well, it has been justified by the share price, but now that Sibanye's share price is getting towards 4-year low levels, and at 16 Rand compared with 44 Rand where it was just a little while ago, you have to start believing that it's now a Rand hedge that is worth looking at. I'm always cautious and very, very concerned about making investments into mining companies, because you are there at the vagaries of commodity prices, and they could go anyway. But when you have a look at the way that the Stillwater deal is going to transform Sibanye, there is an opportunity to consider that quite deeply. We do, of course, have a mining stock in our portfolio in Glencore, but that's pretty much a very special situation. Moving on to the Rand dollar, I've taken this from the Financial Times of London, and if you have a look at that over the last year, we launched this portfolio on the 23rd of January, and as you can see at that time, the Rand was trading around 13.40. Today it's trading around 13.40, but my goodness, has it been volatile in between. In that period between towards the end of March, you saw it get to almost 12 Rand 40, and then in double quick time get to 13 Rand 80. Now, if you're buying into international markets at the wrong time, you can really hurt yourself when you invest in rands. And it's a similar thing on the Johannesburg Stock Exchange in these Rand hedge shares. Another one, by the way, that I'm looking at and have been looking at quite carefully is Phumelela, which has now got about a 70% gearing towards the Rand, and the share price is not expensive at all. Phumelela makes 80% of its profit now outside of South Africa, and essentially what it does is it runs a South African horse racing business, which it then sells the picture of into the global markets and benefits from gaming or gambling that occurs on the South African horse racing. So it's a very, very interesting model, and similar to the kind of models that we see lots of value in. You've got Rand costs, you've got hard currency revenues. Those are the opportunities. And Phumelela is, interestingly enough, it's got Bernard Cantor from Investec and Marcus Jooste from Steinhoff on its board. So those aren't mugs. They've also just done a really good deal in South Africa. So that's another one. So if you ask me, what are we looking at? We're looking at the moment at Sibanye and Phumelela as two potentials to add into the portfolio. But of course, we'll have to adjust the holdings on some of the others to make that happen. The real focus, though, long term, is that we believe that the Rand will be weaker, because we feel that the economic management, certainly under Zumanomics, is not conducive to a stronger currency. And that's the view that we sit at the moment. In the past year, there have been times when we've looked really good, or in other words, when that view has been justified. There have been other times when the view has been completely unjustified, as you can see at the end of March. But on balance, the Rand hasn't done a whole lot, so as a consequence, our portfolio has not really performed significantly stronger than it would have had the Rand been weaker. Just to give you an indication of the changes that we have made, after we began on the 23rd of January with 100,000 Rand, it was invested in easy equities, and you can go straight into this portfolio by buying, as I do, the basket, or sorry, it's called a bundle. You buy the Biznews SA Champions portfolio bundle, and you can put as little as 500 Rand into it. We started with 100,000 Rand in the portfolio on the 23rd of January, and after all costs, etc., we're now sitting on a figure which is 106,000 Rand. So it's about a 5.5% improvement over that period. Don't get too excited, because the JSE overall is up by nearly 9%. So we are lagging the all-share index. But that, of course, the all-share index doesn't take into account dealing costs, and we have to. On this slide, though, that's on the screen now, shows you that we've made two adjustments. We sold those blue label shares at 17 Rand 08 and reinvested the money into Naspers. I'm delighted to have done that, because now at last our Naspers shareholding is coming in line with the market, and I've always felt that it should, in fact, we should be overweight on Naspers. And then the second thing was we sold the Wilson Baileys at 139 Rand, call it, and bought into Glencore. And that too has been a very fortunate decision to have done that. So let's move on. Oh, I see Stuart has, Stuart, I see you've put up a link there.
Yes, I just dropped a link in which will give the breakdown of the portfolio on the Easy Equities website, and it's easy to move from there if they do want to invest. So.
Brilliant. So just a little click on that link, and it'll take you in there, and you can then actually have a very real, as I do, by the way. I've got all of my South African investments are tied up or invested in this portfolio. So you can. It's very easy to participate, and you just know that you're participating alongside the asset manager or the portfolio manager, if you like, which is, of course, yours truly. Moving on to how the portfolio has been doing. It is very, very heavily reliant or dependent on some fantastic performances by Naspers, most recently Glencore, which we only bought, as you saw, a few months ago, and Discovery has done pretty well. Unfortunately, we've taken a hit with Brait and with Steinhoff. Now, Steinhoff in the past month fell quite sharply. There's a story to that, which we'll get into in a moment. But in the past month, Naspers appreciated really well. In fact, let me just to break it down. In the past month, the portfolio is up about 1.5%, about 1,500 Rand, if you like, on the 100,000 Rand. And that came through an appreciation of Naspers, which went from 2,893 Rand to 3,191 Rand. It's a big jump. It's now 21% of the portfolio, and I'm very happy with it at that level. In fact, I wouldn't start getting concerned until it went way over 35% of the portfolio, so it can still appreciate without any concerns there. And the other big move was Glencore. So about 2,000 Rand in the portfolio appreciated through Naspers. About 1,000 Rand was added to it through Glencore's appreciation. And as you can see, Glencore is now trading at 65.08, and it's come from 58.60. So those two have done pretty well in the past month. The losers, so 3,000 Rand up, the 1,500 that went down were Brait lost us 500 Rand, Discovery lost us 500 Rand, and Steinhoff lost us 500 Rand. So that's really, if you look at it overall from that 100,000 Rand portfolio, that's pretty much the way that it's performed in the past month. I don't like doing or judging too much on a 1 month performance, and suggest also that you be very cautious about doing that as well. But be aware that the portfolio now, as it's structured, I'm very comfortable. And here's something that's quite important. It's almost like when you buy into unit trusts on a Rand cost averaging basis, and how that works is that when the price is high, you're buying less units for the same amount that you're putting in, and when the price is low, of course, you're getting more units. And that's exactly what's happened in this bundle here, is that our winners are now appreciating more rapidly, and as a consequence, when you have continuous losers, as we've had with Brait, which started off at 15% of the portfolio, it's down to 10% now. So its impact of its slide is much smaller, whereas the impact of a winner going higher, like Naspers and Discovery, is much greater. And that puts to bed the theory that you should try and take profits. It's one of the worst strategies in investments. With investments, you must ride your winners, because when you get the winners, as we've had on our global portfolio with Amazon and Alphabet, or the old Google, those winners tend to just get stronger and stronger, whereas the losers, if you try and halve your costs of entry into them, you don't always know. The world is an extremely complex place, and the first place to start is to realize that there's a whole lot that we don't know that we don't know. And if you can approach life in that from that perspective, and especially approach your investments from that perspective, and stick in it for the long term, you go into an investment because you have a good understanding of what you think the story is. But when the story goes against you, or when some complexities of which you were completely unaware start affecting you, having a portfolio like this is a very good hedge, because as that unknown starts hurting you, as it's done in Steinhoff and Breit's case, that means that you have a lesser exposure as the share prices continue to fall. I hope all of that makes sense. Does it make sense to you, Stu?
Yes, all good, thanks, Alec.
All right,
unfortunately, no questions, so I'm just trying to encourage the audience to drop anything into the Q&A bar there, and then we'll get to it. As I said, there's no silly questions, just silly answers, as they say. So.
Okay. Oh, I see. They're just comments about the screen, and they can hear them, etc., etc. Okay, that's good. So we see here the number of questions that there are, but of course, comments and questions are the same thing. So please do. We don't want to get into a situation like we had last week, where we ran out of time on the questions. So please just drop them in there. Moving on to the portfolio generally, and just as an overview there, it's developed from a position where we had 4 stocks at 15% each. Of those 15%, we then added to Naspers, and we took that to 16%, and that the share price appreciation is taken it to 21. As I said, I'm happy to stay there, very happy to stay there. Discovery is a little bit higher. Investec, as you can see, it's very close to the purchase price, so it's still at 15% of the portfolio. And Mediclinic a little down, and it's gone to 13% of the portfolio. Brait has been the big loser. It's gone from 15% down to 10%. Glencore, the big winner, is another winner, gone from 8% to 10%. MTN is stable, and then Steinhoff is down to 6%. So as you add, if you're on a monthly basis, it'll allocate it according to the portfolio weightings that we have now. I really like the way that things balance themselves out. Moving on to the all share index, as you see, it is outperforming us. At the top there, this is again from the Financial Times, the 1-year change, 12 months on 12 months in the rand, we have seen an appreciation of the all share index by about 12% in the last year. Since January the 23rd, that's gone from 53,000 to where it is at the moment, 57,500. So that's about just under 9%. And that gives you an indication, though, that down to as low as 51,000 in June, the JSE's had quite a nice run in the last little while, helped along by, well, the volatility of the rand. Here's our big one, and it's the big one on the JSE as well. That's Bob van Dijk, the chief executive of Naspers, who came under quite a lot of pressure from shareholders. I took this photograph when we had a chat at the World Economic Forum last year in the members' lounge there. I didn't get into it. He had to issue an invitation, but a very civilized and an incredibly smart guy. And Bob van Dijk's share that he's looking after, or his company that he's looking after, Naspers, continues to perform really well. There's quite a lot of criticism around Naspers because the view is that because Naspers is trading at a significant discount to its shareholding in Tencent, the big Hong Kong listed company, the view is that Naspers, or every now and then you get people coming up with an idea that Naspers should be selling its 10% shareholding and deploying the cash or giving it back to shareholders or whatever. The latest variation on that came from Mark Mobius, who is the emerging market manager with a pretty checkered track record, I'll have you know, of recent times, but he has no, the media seems to have no compunction or no concerns about that. He continues to get lots of airtime, and his most recent assertion was that Naspers should now be buying back its own shares to compress the discount between itself and Tencent. I guess, but if you are in a situation where you are developing and investing aggressively into other internet properties around the world, you shouldn't really be exercising the kind of approach that highly conservative ex-growth companies like IBM, Coca-Cola, well, they're not really ex-growth, but not exponential growth, which is what Naspers is looking for, the kind of thing that they're doing. But it is a view. It was quite ironic to me to actually have a look at Templeton Emerging Markets. The whole operation that Mark Mobius has got has $29 billion in assets, which is quite impressive. But it's an asset manager that is telling Naspers, which has got $102 billion in market cap, and it's become pretty much an investment operation as well. It's telling Naspers what to do. I don't know. Koos Bekker, fortunately, the chairman of Naspers and the man who's driven it to the level that it has been quite outspoken on this fact, and with good reason. In 2012, we had similar clamoring where Naspers was suggested or proposed that Naspers sells its 10-cent share, and as Bekker pointed out, at that time, the 10 cents share price was 45 Hong Kong dollars. A month ago, by the way, it was 300 Hong Kong dollars. Now it's 350 Hong Kong dollars. So if Naspers had listened to the worthies who manage portfolios and sold out its 10-cent share in 2012, well, you can imagine the criticism that there would be around the company today, that the share price has gone to 350. They know what they're doing. They're riding their winner. They have wonderful insights. Koos Bekker visits China often, engages a lot with Pony Ma, the chief executive of Tencent. They've got a fantastic relationship, and that is an ability from that relationship between Naspers and Tencent, Naspers being the biggest shareholder there, that they can inject and understand how the world is going, or this exponential world of technology and the internet is developing. And we saw a good reflection of this, and this is really in defense of Bob van Dijk, who, as I mentioned earlier, some people are cross at the bonus that he received. Bob van Dijk is the man who's driven the investment into Delivery Hero, which is one of the biggest, if you like, in South Africa, we know Mr. D, which started many years ago, where you would phone up and they would deliver to you from various shops or various takeaway outlets. What Delivery Hero does is far slicker, and it's all online, and every market that it's entered into, it's managed to become number 1 or number 2, and it's growing rapidly. Listed recently, and Naspers in the last month bought another 13% of Delivery Hero. Its total investment in Delivery Hero is now just over €1 billion. The market cap of Delivery Hero is $6.8 billion. Translate that into Naspers' terms, they've invested about €1 billion. The value of what they own is about €1.5 billion. That's €500 million that this investment has made for Naspers shareholders. And if you work that into South African terms, it's 8 billion rand. Now, I don't know how you can start casting aspersions at a chief executive who has generated that kind of an investment for you. For me, Koos Bekker had the whole world to select from. He picked Bob van Dijk, and his selection as CEO is doing a pretty fine job indeed. No doubt that there would be lots of people happy to take him into their fold from Silicon Valley if you were to have some insanity occurring where shareholders prevailed and not only got Naspers to sell their 10-cent shares, but to get rid of Van Dijk as well. Sometimes businesses should just be left to, especially successful businesses, in my opinion, should be left to continue on the path that's got them there. Anyway, it's a nice example of the value that Bob is adding to the company.
Discovery. Sorry, while you're on Naspers, Alex. Yvonne wants to know, is it too late to invest in the company? And what about investing directly in Tencent, which I know we hold in a global portfolio?
On both scores, it's not too late. What we do in our view is that we take a look at the company, we understand about it, we then look at what the potential will be in the long term from the current share price levels, and in all of those instances, I'm very comfortable, very happy to be invested in both of those. We, as Stuart says, we do have Tencent, a fairly belated addition to our global portfolio, and that's really performed extremely well. Naspers, you're getting a huge discount on Tencent, and particularly if you're based in South Africa, then this is your route into Tencent. So it's not too late. You're getting a huge discount to the underlying value. Sometimes people just don't, the numbers are so big. Look at that, market cap of Naspers, 1.4 trillion rand. It's about 1/3 of the value of the GDP of South Africa. Now, when you look at that, you've got to kind of rub your eyes and say, is it possible that there's a company listed, primary listing on the Johannesburg Stock Exchange, which is worth about 1/3 of the value of the entire economy in South Africa? And that's what you're talking about here. So when you start unpacking the numbers, it looks so big, a bit like Apple in the US, and you've got to just take off your blinkers and work out, is it value for what it's achieving at the moment? Is it value for the revenue that's being generated? And in Naspers' case, because you're getting a 20% plus discount on just the Tencent shares, everything else, including Delivery Hero, which I've been talking about, and all the other investments, Mail RU, the multi-choice investments in Africa, all of that comes for free. So I think it's if you can get your head over the numbers, knock a couple of, Buffett always used to say, when you're looking to, Warren Buffett, the world's greatest investor, and certainly one of the great teachers about investments, he says that if you are going to invest in a company's shares, imagine, knock a few noughts off, and imagine you're buying the whole company, and then look at the numbers in terms that you can absorb. If you do that with Naspers, you'll see it's offering excellent value. So certainly on that one, my view on Tencent is that it's in a incredibly sweet spot. It has 900 million people. 900 million people, 3 times as many people who live in America. 900 million people in China who use Tencent as their operating system on their mobile phones. So it's captured, if you like to use a South African term, that market, and it can now sell things into the market, and has been doing so hugely successfully with games, and through that is where Tencent is. And it charges, it actually started off by charging 10 cents for someone. Now it's equivalent really of South Africa, it's 10 cents, because the Hong Kong dollar and the rand are pretty similar in value. So imagine charging someone 10 cents for access to something. It's a micropayment. The micropayments have transformed that company. People don't mind paying 10 cents to participate in games or whatever it is, and that's where the business started. So charging small amounts, tiny amounts actually, but huge volumes. When you've got 900 million people in your ecosystem, my word, it's another Apple, but of course it isn't. Apple, by the way, has got about 1 billion people in its ecosystem. So there's not much difference between the two, and both of them can make enormous amounts of money by just charging very, very small numbers. So sorry for the long answer there, but yes, I do like both of them. Moving on to Discovery. There's been some negative press on Discovery. Negative, well, I won't say negative press, because they manage their press relations very well, but some negative vibes around the company since its results were released. The results were very good. Particularly the UK operation, Vitality, which is making excellent inroads here. Living in the UK, you can see how the National Health Service is creaking. You can see how British tax allocations are going to continue to put pressure on the service delivery of national health, and as a consequence, more and more people who can afford it will be moving towards Vitality. So they've come into the market at pretty much the right time. I'm not sure where the negative vibes come from in South Africa. It could be to do with national health. It could also be perhaps an overvaluation of what Discovery will be doing in the banking market. They've spent a lot of time developing their own banking model, and in the past month we have heard the news that Commonwealth Bank of Australia have entered the South African market, and they will certainly be putting Discovery and, well, not just Discovery, but all the banking companies in South Africa under a lot of pressure. To give you an idea of the scale, Commonwealth Bank has a market cap which is the equivalent of First Rand, Standard Bank, Investec, Nedbank, Capitec, ABSA, and then plus another 300 billion on top of it, rands. So that's, add them all together, all the South African banks together, put another 300 billion on top of it, and that's where you get to the value of Commonwealth Bank. So it's a big player, and it's identified South Africa. It's launched, it's got a banking license, it's launched a digital-only bank, it's going to be a big competitor. And maybe that's another reason for Discovery coming under a bit of pressure in the past month.
Thanks, Alec. Just on the banking side of things, Theo he says local banks appear cheap. What are your thoughts?
They are by historical standards, but the competition is intensifying. As I was mentioning now with Commonwealth Bank, it is a concern that you have this huge player coming into South Africa, and you've got Discovery in the wings, and we know what they've done to the healthcare market in the country. Of course, you've got Capitec, who are continuing to grow at 17, 18% and growing market share. So banking is not an easy place to be right now. The ratings of the South African banks are reflecting this. On the upside, I guess, is that never forget that banks are in the business of borrowing from depositors and lending out to those who want to borrow from them. And most of the lending that they do is to corporates, and when they can lend more, they can make more money. They also get a big chunk of their earnings from corporate actions when the companies themselves are active, when they're expanding, growing, merging, doing those kind of transactions. Then the traditional banks, and you could say the big five in South Africa, well, who are the big five now, but the old traditional banks in South Africa, FirstRand, Standard Bank, Absa, Nedbank, and Investec, they would benefit from a improvement in the economy, or rather they are closely related to the way the economy performs. And the South African economy has been under enormous pressure. Socio-political reasons are a huge part of it. When you have uncertainty, then you do not get the investment in plant and equipment and expansion of job creation. And if you're not having investment, nobody's asking the banks for money to lend. And if the banks aren't lending money, they are not able to expand their profitability. On the other hand, if the economy is in trouble, the banks find that the bad debts that they have to write off start escalating as well. So when you see an improvement in the South African economy, that's the time when the South African banks will be re-rated. Not until then. The rating on Capitec, as I mentioned quite stridently after their financial results, I think it's a fantastic company and brilliantly run, but the rating has just gone into the stratosphere. At that time, they were trading at a price to book value of 7.2 times. Now, if you take FirstRand is on a price to book value of under 2 times. So you're saying that Capitec is going to grow 3 times faster than FirstRand will indefinitely until Judgment Day. Clearly, that's well, not clearly, but in my opinion, that is a bit of a stretch. So on the one hand, FirstRand might be a little undervalued. It's a fantastic operation, as we know, one of the most innovative banks in the world. But Capitec, on the other hand, is probably overvalued relative to it. If you were to make a bet on banks, I think that you're probably going to be doing your work on the economy. What happens in December at the ANC elective conference is very important. It will give us an understanding of whether we'll continue with a confrontational approach between government and business in South Africa. That would be the election of Nkosazana Zuma. If you were to have Cyril Ramaphosa elected as the president of the ANC and then presumably of the country after 2019, and I say presumably because lots can happen in that election too, but if that were to happen, then the banks would certainly rally, because there would be a perception that Ramaphosa, who is part of the establishment, if you like, would be better positioned to get the economy going again. If you had the compromise candidate, Zweli Mkhize, coming in, the banks would probably rally a little, not as much as if Ramaphosa came in, but that would be on the basis that he is a man of integrity, it appears. Certainly all the work I've done shows that he is. There's all kinds of talk going around at the moment, as happens in the political environment, where virtually all of the candidates get bad mouth from one camp or another. You just need to be very cautious about what you believe. But someone like Zweli Mkhize could be pretty good for South Africa in the long term. We have to see, though, which way the cookie crumbles in December. I would say do your homework on the banks, find the one that appeals to you most, and if you are confident that Nkosazana Zuma is not going to be elected, then you might well follow your gut and build yourself a little position in banks. They're so far down at the moment. We're really talking about the big four banks that there isn't really too far to fall from these levels anyway. So your downside risk is capped, whereas there is upside potential after the December elective conference.
Thanks, Alec. A question on Facebook, which obviously is not a local stock, but Terence says he's an advertiser and he sees the dominant role it plays, and it is going to play worldwide. It looks like a fantastic buy. Obviously, we do hold it in the global portfolio as well, though.
Yeah, I'm a huge fan of Facebook's. The reason why is because you do have these this dominance in, well, let's just go back a little bit. In the media industry, in the past, you had very few routes to market, and those routes to market meant that advertisers could pretty much pay what the newspapers and the radio stations and the television stations decided to charge. Now there are infinite number of routes to market, and the old traditional advertising model is completely broken. In its place has come a cut price option, which is not only much cheaper, but is also far better targeted. So what Facebook can do is they can give you a target, or give an advertiser a target within an area. I mean, you're looking at a beautiful picture here of Mediclinic's head office in Cape Town. If you were, for instance, to take that little area, I think this is, or just take the area, take the City Bowl in Cape Town, because you had a service that you would like to deliver to them in the City Bowl area. You can then target only people who live in the City Bowl area on Facebook, and of course, so it makes your target market much smaller, and they will charge you a fraction of what you would have been paying through traditional advertising vehicles. The market doesn't always tell the truth, but it in cases like this, it rarely lies, and that gives Facebook a massive advantage over other media companies in the areas that it operates in. Of course, when you look at Naspers, it's an obvious question. Wow, what's going to happen to Naspers then? Well, Facebook doesn't operate in China. So Tencent, which is Naspers's bulwark, if you like, is shielded from that kind of operation until it gets its own social media side together, I guess, at some point. But Facebook is, it has a model which it's only now starting to explore. I've heard internet experts say that if you were to take the internet's development in a context of, say, a year, we're probably only in the first couple of weeks. So there's a long way for the internet to develop, and Facebook has this incredibly strong position of over 2 billion people that it serves at the moment, where it can now move not just from advertising, but moving into financial services, etc. So Buffett says you should buy a share that if the markets close and you come back in 5 years' time, and the stock markets, that is, when they reopen, you'll still be happy to be owning that share. With Facebook, that's one of those very few shares that I can look at in this uncertain world and say I'd be very happy to be owning it today, and I'm pretty confident that in 5 years' time the investment would have grown. Should we go on to Mediclinic? There's not really a lot to tell in this past month. It continues to bump around there. Mediclinic is listed. It's one of the FTSE 100 top 100 companies there now, so it is affected by the rand movement. As you can see there, it came under a little bit of pressure early in September and then bumped around a little bit more. This is a stock that I really do think is significantly underpriced. The reason why it has fallen is maybe there was a bit too much excitement in the time that it went ahead to list on the London stock market. It's come back now. When you're in fashion and you go out of fashion, you tend to go a little bit further or out lower than you should go to. But on this one, very happy to have it in the portfolio. It's continuing to edge very, very slowly on where, in fact, almost identical to where it was a month ago, and a good, strong, well-managed business. Yes, here's the one that's been causing one of our problems. My goodness, look at that. Here's a share price. Thankfully, we only bought it in January around the 80 Rand mark, but those who bought it a year ago would have paid double the price. And it is a company that has been really hit hard by one purchase that it made. It bought a business in the UK called New Look. It's a fashion retailer. The decision to buy New Look now is something that Christo Wiese would love to undo, as probably anybody would if you'd bought something for over £700 million, and the value of that investment has now gone down to, well, they've written it down to a fraction of that at the most recent balance sheet. They acquired 89% of New Look in June 2015, and it actually just brought all kinds of new debt onto the balance sheet. It, of course, sucked up a lot of the cash that used to be in Brait at that point in time, and it was at the same time, or around the same time, that some of the other acquisitions were made. Virgin Active, which was going quite nicely, Iceland Foods, which Wiese already had a stake in, that he bumped it up. But New Look is the problem. In the last month, we've seen, or we've heard in the marketplace, that New Look is now renegotiating its debt, or trying to renegotiate its debt. It's lost its chief executive. So it's weighing heavily on the share price. In fact, there are quite a lot of short sellers of Brait, even at these levels. But I remain optimistic, hopefully optimistic. And the reason I do is the insiders are really piling into the stock. The Brait team are heavily leveraged towards the Brait management team, heavily leveraged towards the ownership of the shares. They've got about 2 billion Rand invested, which they've borrowed to make the investment. And in the last month, they bought another nearly 20 million Rands worth of shares at 56 Rand. So that's, as you can see, just where the share price is at the moment. That is a discount of 28% on the net asset value at the end of June. So what are you getting from Brait? You're getting New Look, which has been written down to pretty much disaster or Armageddon prices. That's the big problem. That's the reason why the share price has fallen so much. You've got a very good business in Iceland, which is a retail chain in the UK, which actually is very popular because it sells iced products. So stuff, food that you can take from the store and put it into your deep freeze or defrosted meals, etc. And very popular. It's highly price competitive. It's then got Virgin Active. And the UK, like many other parts of the world, is becoming a lot healthier. The gyms in this country are booming, and Virgin Active is very focused in the area of the country which is the most health conscious, which is London. So that was 692 million, by the way, that they paid for Virgin Active in 2015. They value it at almost £1 billion now. So that's a big part of the business. And then they've got in South Africa, Premier, the old Premier Milling, which is a 10 or 12 billion Rand business. Just to get back to New Look itself, they paid £783 million for it, and that price has been written down to under £400 million. So that's been the real hit for Brait. If the insiders are of the opinion that they can at least stabilize New Look, if not necessarily turn it into a magical or turn a magic wand on it and increase the value of it, well, that's one thing, but they are certainly buying the shares at 56 Rand. And you rarely go wrong when you follow managers, particularly managers who are in the business who are risking their own money. Christo Wiese is a great entrepreneur. He's going to be borne out, I'm sure, on this stock in the long term. Of course, it is the ultimate pound hedge, and we also know that the pound is at a point now where the appreciation in the currency is starting to work through. There's sanity prevailing within the UK on Brexit. There's every day you would have some bit of news that'll knock the pound one way or the other, but generally speaking, sanity tends to prevail in these situations, and should it continue, the pound will recover from its post-Brexit levels, where it still is, it still hasn't recovered to those levels yet.
Just on Bo wants to know, says, if New Look is teaching and renegotiating debt, is the price at 56 Rand not still under pressure?
Now, it's a good question. It appears to me, and certainly to the insiders as well, that the price is reflecting Armageddon for New Look. So it's renegotiating debt now in anticipation of the debt it has to. It's got a few years, so it doesn't have to. There's no necessity to renegotiate debt or you go bankrupt. It's not in that position. It's just looking at it, looking at interest rates. They might be rising soon. Is there a way that they can secure themselves for even longer? That's the discussions that are going on there. It isn't a discussion of banks or missing the covenants and having to call it up. So I think markets, or rather investors, are pretty skittish about this share. To come back, to see the investors coming back into Brait in a big way is going to take a lot more than just a few months. Remember, they did get rid of their chief executive at New Look a little while ago. I think it was last month. He'd been there 5 years. He'd been there through the transition from the old private equity partners to the new ones, which is Brait. It's in the price, and I think if you're a bargain hunter, now's the time to be adding Brait to your portfolio, but I wouldn't go too big on it, because I don't know what I don't know, and I think it must go for all of us. We don't know what we don't know about Brait. The insiders are suggesting to us that what is in there that we don't know is good news, but the market is saying to us it's still reserving judgment. And the best time to buy something is when it's cheap, and there's no doubt that at the moment Brait is cheap. But don't put your whole portfolio in it. I think that's really my message on it. We're coming to the end of our discussion for the day, and here's been our real superstar performer, Glencore. Some localized news in the past month was that Glencore has now bought Chevron South Africa. It's invested $1 billion. Chevron is the company that's got a refining plant, about 100,000 barrels a day in Cape Town, and the Caltex service stations. There are 820 of them around the country. So it's now 75% owned by Glencore, 25% owned by the BEE partners. Interestingly enough, the BEE partners objected to a deal that was done with China Petroleum, Sinopec, and as a consequence of that, that deal unraveled. So Chevron wants out of South Africa. It sold to the Chinese. The BEE partners weren't too keen, and Glencore's come in. And this is interesting for for so many reasons, but it's also supporting a thesis that seems to be coming out increasingly. There is a lot of rumor mongering and fear mongering in South Africa at the moment. I think it certainly supports certain political parties or political objectives. I heard the other day that if Nkosazana Zuma does not get appointed, there'll be civil war in South Africa. Of course, anything's possible, but that just seems really, really far-fetched when you have a look at the sophistication of the country as a whole. But it's that kind of rumor mongering that is making South African assets incredibly cheap. And for a Glencore, and especially with a Johannesburg born and bred chief executive, Ivan Glasenberg, they can see through the short term, and it's more likely that the country will muddle through than go into some kind of a Zimbabwe-like decline. Even the great pessimists won't put more than a 20% chance of a Zimbabwe-type ending to the South African political situation. And that's the bet that Glencore's made here. It's made a big investment. These guys are shrewd. They've got cash now to spend. They're busy doing a similar investment in zinc in South America, a company called Volton, $500 million that they're putting in there. And it's interesting that Glencore was only a couple of years ago that it was overgeared. In other words, had far too much debt. The share price was in the doldrums, and it's now come back from that by being nimble and showing that even if you have a giant business like this one, if you do position yourself differently, you can take advantage. And this is the time. It wasn't the time to be buying mining assets in 2008, 2007, 2006. That was the wrong time to be buying mining assets. That was just before the burst. Now's the time to be buying mining assets, but the competitors to Glencore in this field are all themselves overgeared, as Glencore was. But it's wiped that gearing out. It's now sitting there able to make good purchases, and it's looking through the South African troubles, if you like. But even for Glencore, $1 billion investment is a big one. So Celtic Service Stations are now owned by Glencore and its BEE partners, and it's making a bet on the future, which, as a South African, if you step away a little bit, is not a bad thing at all. And finally, MTN, it's just bumped around in the past month. We are still very positive about the new management team. It's the kind of thing you expect from a new broom sweeping clean. MTN had to focus internally, had to get its internal operations in order before it starts rushing out into exciting, more fashionable kind of activities that gets the investment community excited. So we don't know when that's going to come. It could happen in the next month. It might take a year. But at these levels, 126 Rand a share, MTN still offering excellent value. Steinhoff has been the big disappointment of the past month. I'm not worried about this at all. The reason for the share price decline was the listing of Steinhoff Retail Africa, or STAR as it's called. Seems the market isn't mad about that. Well, anyway, that's everyone has their own opinion. Steinhoff has roughly 20% now of Steinhoff is tied up in STAR, and STAR is a business that is effectively, it's about 2/3 the old PEP and Ackerman, the old PEP Africa and Ackermans, and then the other 1/3 will be the investment in Shoprite. Now, Steinhoff, because of its relationship with Christo Wiese, is in a position to exercise an option where it has a controlling vote in Shoprite, but about 30%, about 20% of the economic interest, 23% to be precise. So that's going to turn Steinhoff into the 15th biggest retailer in the world. It's complicated. People have been looking through it, but I do like the way that Glencore Capital, and there's a piece on Biznews today if you'd like to go and read it, the way that they unpack it. And their view is that, and they're big shareholders in Steinhoff, their view is that this makes Steinhoff, the parent company, even more attractive than STAR, and particularly after the recent decline in the share price. So I'm happy that Glencore Capital still like it. I'm very happy that Marcus Jooste has managed to get the group positioned in such a way as international investors can start discovering it, not just because it'll be in the top 15 retailers in the world, but because it is now 80% international, and very clear lines between the African operations and the rest of the world operations. And I'm also like Steinhoff on the basis that it has been contaminated with the anti-Amazon brush, i.e. Amazon is such a bulldozer that whenever it goes into a market, it gets the incumbents catch a cold very quickly, catch pneumonia, if you like, and their share prices fall. But Steinhoff is positioned in those areas where it's not exposed to the Amazon effect, primarily through big goods, mattresses. You don't sell too many mattresses on Amazon because they're big. Amazon specializes in digital distribution and in small products. That's on or easy to distribute products. And secondly, because it's very strong in the bottom end of the market where the margins are so small, a Poundland, for instance, where there's no margin in it for Amazon to sell and distribute it. So that protects Steinhoff as well. I'm very happy with Steinhoff, and if you haven't got it in your portfolio, it certainly is one to be adding.
Thanks, Eric. Just two quick questions to end up with. Shirley wants to know, is Glencore a good buy at the moment? And then Peter Mansfield just asks for thoughts on Dis-Chem.
Peter, I haven't done any research on Dis-Chem because it actually falls outside of the portfolio, unfortunately, given that this is just for SA Champions. I can't help you with that one. Shirley, Glencore at these levels, you've got to start scratching your head now because it's up by a third since we bought it. We bought it on the basis that it is repositioning itself into the electric car field, and that's a story that hasn't even started yet. But whether it's run too far in the short term is a possibility. It's almost like from where it was to where it is today, it's now putting in the premium for being focused on electric cars. Remember, if you go back to the reason why we bought into it, at the annual general meeting, Glasenberg focused his whole presentation on how Glencore had been moved away from being a traditional commodities business into a business that was focused on new age commodities, and particularly on those commodities that were going to be used, copper, nickel, going to be used in electric cars. So that was, it was almost, we had a bit of an uplift there from our perspective. They've also been helped, the share price has been helped by an improvement in the commodity prices. But it is getting to a point now that if you're looking for a commodity stock, I'm wondering whether it isn't time to be investing in Sibanye-Stillwater, because that's the way markets go. You get this overreaction, as there has been, on electric cars, so getting hammered are platinum and palladium stocks, and then they get dislocated. So the market goes too far in the one direction and too far up, and then too far down as well. And if you are in the commodities field, you've got to take note of this. Commodities generally are for trading. Glencore just looked too good to be true at the price that we bought in at, given it hadn't really moved then on its exposure to electric cars. Would I be putting more than 10% of my portfolio in it today? Probably not. So we have a 10% allocation, and that's a healthy enough investment if you are wanting an exposure to electric cars. Unfortunately, Tesla's not listed on the Johannesburg Stock Exchange, but if it were, I would rather be going for Tesla. So, but as it isn't, this is your route into that very, very exciting market. But remember, you're taking a long-term bet on it, and the long-term bet on electric cars is that within 20 years, 25 years, we are going to see the end of the internal combustion engine and being replaced by the electric engines. And Glencore is best. Cobalt is the other mineral that I didn't mention earlier. It is best positioned of all the resources companies to benefit from that. It's like they sell the pick and shovels of the mining boom, if you want to put it in a different way.
Thanks, Eric.
So Stu, that seems to be the end of our presentation today. It's been great chatting through the portfolio once again this week. It has been a interesting month, but it always is an interesting month, as we know. And I think that the watchword in all of this is just remembering why you invest in the SA Champions, and it is a bet on the rand, or a bet on a weaker rand. So it's a hedge that you're taking against poor economic policies in South Africa, and you are enjoying that by investing in companies, South African or JSE-listed companies, that can benefit from an appreciation in the of their assets in the global environment. There have been some ups and downs, but generally speaking, the portfolio is in front, and it is a long-term portfolio. Even if it were down, if it were significantly lower than our entry point, I would still say to you, please look at this as a 3 to 5 year portfolio. When we do make changes, they are for fundamental reasons. So Wilson Bailey, for instance, we fundamentally felt that they had run out of runway in South Africa, where a big part of their business is, or were running out of runway because of the economy in South Africa, and Australia wasn't performing the way that we thought it would. A similar thing with Blue Label. They doubled up on their South African bets with the deal that they did with Cell C, and that doesn't really play to this portfolio, which is a global champions portfolio. We did bring Blue Label in initially on its India and Mexico businesses. So from here, maybe there would be a lightening of some of the shareholdings, but generally speaking, I'm very happy with the way the portfolio is structured. And if you're going to get something to replace something in the portfolio, or to add a new one, a new stock into the portfolio, it's got to be something that it's very cheap, and you have a very exciting outlook on a 5-year horizon. So I hope you've enjoyed the presentation today. Thanks for all the questions, and we'll be back again next month. But Stu, we've decided we're going to do something different next month. We're going to move to an evening webinar rather than having it over lunchtime, to maybe go around about 7:30 in the evening, and that does give people a little bit of a better time to be at home and doesn't break into the work day. We will be polling Biznews Premium subscribers to get a better feel for that, to make sure that we're on the right track there. But that's one of the enhancements that we're keen to make.
Yes, thanks, Alec. We'll see what the response is and what time works best, to 7 or 8 or 7:30, and just see how we go from there, and see if it is a better option than the lunchtime. But let's see.
Great, super. Well, thanks for being with us again, and enjoy the rest of your day and indeed the weekend.